What do you think the market for the next sort of 12, 24 months is going to look like, say, in your space?
I actually think given the space we play in, that sort of bit big or SME and a bit bigger corporates, I think it's going to be okay. People will need to solve this people problem. Businesses should fall over. You guys should be busier, is my view. And, the Australian dollar is very weak against the US. So if you're leaving the US to come to Australia, housing is actually much cheaper in Sydney than it was 18 months ago, which I know sounds bizarre given the prices in Sydney. I think the interest rates will continue to climb. Probably have more concern about how much have they got to climb to actually make a difference, because there still is a lot of cash around that came out of COVID. Probably the one thing we've seen a little bit, and we don't do a lot in the space, we've seen a few of the PE firms having to hand cash back because they didn't spend it in time. I think as you and I have discussed a lot over a coffee, this too will pass.
Cathro and Partners presents The Cut, a podcast about all things insolvency.
Well, hello everyone. My name's Simon Cathro. This is the next episode of The Cut. I'm from Cathro and Partners. We are a restructuring and insolvency firm. The podcast is designed to interview interesting and personalities. And today's personality is Dave Ellet from Moxon Capital. How are you, Dave?
G'day, Simon. How are you?
Yeah, good. Thank you for coming on our podcast. It's great to have people like yourself come on there. And to get started, I just wanted to allow people the chance to get to know your background and where you've come from. So, do you want to spend a bit of time just giving us an outline of who you are?
Yeah, it's no problems at all. So my background is a chartered accountant by training. So did my chartered exams in Melbourne, initially started in audit in Melbourne and then drifted into insolvency, finding that a little bit more interesting than the audit. And then, over the last 20 years, I've had insolvency, corporate advisory and CFO roles, both here and in the UK.
Great. And tell me about some of the more interesting jobs you did in that period. Like, what would you say was one of your most interesting matters you worked on?
I think, as you know, from certainly with the insolvency stuff, you get to work with lots of interesting characters and meet lots of interesting people, often at times under a lot of pressure. So, I was lucky enough to spend some time at McGrath-Nicol and worked on a few large files there. ABC Childcare was an interesting one where you've got lots of upset parents and kids and toys and, landlords. That was good fun. Henry Walker Elton was a mining services business based in Perth that we worked on a sale process for about 12 months. That was a good result for everyone, mainly because everyone kept their jobs, but also everyone received greater than 100 cents in the dollar back at the end of that process. So that was unusual. For the last 10 years, I've run my own corporate advisory firm. So I've built a business around the bits I loved out of insolvency, which was the buying and the selling, and also helping people source capital. So, we've worked on some great stuff over the last 10 years, but probably more than the transactions, it's the people you meet along the way. And we worked on a good sell side gig about 18 months ago where we helped some guys who had built a business off the back of a beer coaster in a pub, quite literally. And just watching those four founders get a good result. And then the 18 months since, they've all been able to go on and do some interesting stuff, ranging from building houses to moving family to Australia to all sorts of things. So, I think with what we do, it's probably more about the people than the actual deals. There's always another deal. But, the bit I love is the characters we get to meet along the way.
Yeah, the outcomes, they are the most satisfying, particularly the ones where there is a good outcome. You look at the Henry Walker one and that's a full return, and that's pretty satisfying because it's quite a rare thing in insolvency to see everyone get paid back in full and then a business sort of kick on to being a stronger business. And if you look at that particular job, like what was the sort of reasons why it went into an insolvency appointment? It's a lot of years ago now, but they basically had a capital squeeze. They got involved in some unprofitable projects. There'd been a fair bit of litigation around a couple of their jobs as well. So, it was a combination of things rather than just one thing. Probably sadly,
to see that business fall over should have gone into administration. That'll always be the great debate. But I think what it did prove that if you run a good administration, it can achieve a good outcome for everyone. As you know well, administrations can be an expensive process, but what it does allow is a good outcome for people at the end of the day. And that was obviously satisfying for everyone involved.
Yeah, often in those administrations, there's a lot of changes that we do during the process before we put it to market.
Yep.
Was there a lot in that particular one where they had made a lot of changes, which the administration process allows? Because if you've got unprofitable contracts, like you mentioned, you can get out of those contracts, and it was that enabled that to occur.
Yeah, it did, and it enabled for some negotiations around those contracts as well. Bringing forward payments to allowing funds in to actually run the sale process. I was working with the good guys at McGrath-Nicol then, and we used Macquarie Bank to run that sale process, and they ran a good tight sale process. And I think everyone took a view early on that it needed to stick to some really tight sale timelines, because the one thing that kills deals, as you know, is time. And if you don't get things done in a reasonable way, you have customers stick. I worked for a guy that always used to use the phrase "stick with us and you'll wear diamonds." If you don't show some progress pretty early on, then all of a sudden you're going to find those customer contracts are falling away, or your competitors are out there trying to steal the customers, which is fair enough. It's a competitive marketplace. So I think with that sale in particular, they made some changes. They put in an external CFO who went on to do some good stuff, and then just really ran a tight sale process. And the guys that ran that process knew the industry well, so it meant a lot was achieved in a short period of time.
Yeah, even if you look in recent times around some of the bigger transactions like Virgin that Deloitte did, that was a really quick turnaround.
Yep.
When you compare to, say, other older administrations where it's been a much longer process. But and now you see the fruits of that quick turnaround. Virgin looking to list, and it has really kicked on since the acquisition. So moving back to, so you're at McGrath-Nicol, you've decided I'm going to go out, do my own thing, Moxon Capital. So tell me about what's going through your mind at the time when you set up the business.
Yeah, it was an interesting time because I think my wife at the time was 7 or 8 months pregnant, and with our first child, and I'm not sure my parents, or my father-in-law in particular, actually thought it was such a wise plan at that time. But I decided I just felt it was the right time to have a go for myself. It was something I'd always wanted to do. I just finished an MBA, and that sort of stirred me along a bit because some of the guys that I got involved with as I did my MBA were pushing on to do their own thing. And I wanted to have a go at something not necessarily totally new, but take something that I liked and enjoyed doing, and see if I could build a business around it. And I've been lucky enough to do that. I've had some great supporters along the way. I think one of the things I've been lucky to have is some good mentors in my career, and they come from all different sources. It doesn't necessarily need to be a partner at a firm who's been a great mentor for you. They've been business owners. They've certainly been employers of mine, and lucky enough also to have a very very supportive wife who's also worked on a lot of transactions, so she understands the ups and downs of that process. But Moxon's real centre is about helping people buy businesses and sell businesses. Probably the bit that you and I have talked about over the last few years is we've also now moved into talking to people about capital requirements, and that tends to be around alternate debt. So that non-bank lending is something that we've just from being involved in transactions, people being frustrated that they're going to sit in a banking process for a long period of time and they just want to get on. So that was a natural progression for us to be helping people source that debt. And then we've just had some good support along the way where some friends of the firm, for want of a better phrase, pick up the phone and ring us and say, hey, can you help a client with this? Can you help a client with that? I think very early on I worked for a guy called Michael Nafalai, who's based in Melbourne. And Michael had a great process around, you're almost got to be like a tugboat. So you're out there every day just bumping people, just pushing, not in an aggressive way. But certainly that's something that, I've just taken from working from him. And, we do a lot of coffees. We do a lot of chats. And happily, you got to recognise that a lot of those won't turn into formal paid work. I'm always one for, if it's not for us, can we find someone to give you a hand? Because I think, there's certain, you wouldn't, if you're an accountant, you wouldn't build your own house. And I think trying to convince people that, they getting some proper advice off someone has got some experience in that space is just invaluable. And it might not be the day you get the check. It might be in 18 months' time after the transaction's closed that someone's looking to look at warranties and indemnities, and people are revisiting parts of a transaction. And if it's done properly up front, I think it helps people sleep at night. So.
Yeah, and one of the things from that, it's one of the wonderful things about having had an insolvency and restructuring background. You get to learn a lot of these sort of skills around selling businesses and the different parts to a contract and the different processes. Yes, you don't have a warranty clause normally in a sale process for when you're an administrator, but they're not hard to pick up in time. Yeah, the network you mentioned is important. I mean, if you just do the right thing by your network, new contacts come across. For you, like if you look at the size of contracts that works for you, what's your sort of sweet spot in that sense?
Yeah, I was thinking you're probably going to ask me that today. It's more the area we play in, and I'm not avoiding the question, but we've worked on transactions where the consideration's $1 and take on employee entitlements. So we've probably combined done, I don't know, $800 or $900 million worth of transactions either been involved with or led over the last 15 years. Our sweet spot, it tends to be a family-owned business or a smaller corporate that's looking to do an acquisition. Those acquisitions tend to be off competitors, so we don't tend to do a lot in the private equity space. We know a lot of the private equity guys, and they're good guys, but our bread and butter is more in the corporate to corporate type transactions. And naturally, as time's gone on, businesses that were worth $2, $3, $5 million are now worth $40, $50, $60 million, with the same ownership, and that tends to be where we play. I think the other thing that's become obvious over probably the last few years is Australia's quite an attractive place to do business. So we act at the moment we're acting for a group out of Sweden who have helped with transactions in previous years, buy bolt-on businesses in Australia, and for our client in Sweden, they find Australia an attractive place. There's good legislation, the law's easy to follow, the people are in some ways easy to deal with, and they get what they get. I think one of the things we're trying to teach them a little bit about now is, sometimes in distress situations there can be a bit of a gem in the bottom. So trying to explain to someone voluntary administration, deeds of company arrangements, creditor trusts into Swedish, that's certainly a challenge. But, I think 10, 15 years ago, people wouldn't have made the effort to go all the way to Australia to do a deal. But I think now people are happy to, particularly with Zoom and other bits and pieces. Travel's so easy outside of COVID. You can talk to people via Zoom, as you need. So I think certainly people offshore looking into Australia to do bolt-ons is an attractive thing. So we're going to continue to talk to people we know overseas about opportunities that come up in Australia, and then we've just got our what I call our bread and butter deals, which is corporate A talking to corporate B about merging. Often sometimes there's a succession piece to that. A founder's got through COVID, he's just decided he's had enough, he's looking for something else, or she's wanting to move on and do something else. So they tend to be the type of the corporate tries to transactions we do. We don't act for ASX listed entities, but we certainly help clients buy divisions of ASX listed entities, and that comes with a whole heap of challenges as well. But certainly the stuff we probably get a bit more passionate about is where it's family owned or founder owned businesses looking to do a transaction rather than a corporate, because you're dealing with people that's actually physical cash going in their own pocket, and for many people their wealth is often tied to their business, so they need some sort of transaction or exit just to release some capital for themselves, whether it's for retirement, family, kids, whatever it's going to be. So that tends to be where we like to sort of spend our time searching for work.
Is there any, I know with every transaction it's got its own uniqueness, but is there any sort of, you think about tax structuring, you think about the legal terms of a contract, the operations, the transition. What are the sort of key considerations that a party may need to think about when they've made this decision or are thinking about either selling or wanting to buy?
Yeah. I think, for us, it's all about preparation. I know that can be a bit of a, motherhood statement, but, we try to encourage people to do some simple things. We're talking to someone at the moment and they haven't got their shareholders agreement signed. It was drafted 3 years ago and no one ever got to signing it. Okay, so what happens if something changes during the sale process? Where are we going to be at? I think one of the guys that works with me, so we've got sort of a core team, and then we've got some guys that come in and advise or assist as we need. He's ex-military. And his great thing is, you spend 100 hours sharpening the axe before you start the job. And it is hard to convince people to do that because they're like, no, I'm ready to sell. Let's get on with it. And you're like, okay, well, let's go through a process. So I think, for us, the preparation, getting your business in order, from a financial point of view, it tends to be okay. Most people at the moment, given the ATO reporting and other things that people need to do, it's often up to date. I think it's the bit I encourage people to do is often with the businesses we sell, the founders have got to tell a story. And what I've found is the good results we get tend to be with founders that can tell are good storytellers. So we get them to think a little bit about, where they've been, where they are now, and what they think the opportunity is going forward, because that's the piece you really need to convince your buyers on. Preparation, management presentations. We certainly talk to people about financial forecasts. We spend a lot of time talking to people that don't put a financial forecast in that's got a hockey stick, because it reflects badly on everyone, to be honest, because unless it's true and you can say we're about to go gangbusters, absolutely do that. Like that's fine. But if you put stuff like that in a data room or in an information memorandum, people then tend to start asking, well, what else are they trying to sugarcoat? So we encourage the guys, but you got to sprinkle some fairy dust over the top, right? But encourage people as best they can just to be logical about it. DD, as you know, DD processes are hard, and then everyone's got an opinion. And then people that aren't involved in the process have an opinion because they met someone at the pub who said, do it this way, and they got a great result. So we also encourage people, take everyone's advice, but, put a filter on it as well, because not everyone is involved. Get some good legal advice. We're lucky. We've got a group of lawyers that we work with, but certainly we also work with advisors or lawyers that have worked with people before. What we encourage people to do there is just have a think about whether your lawyer has got the skill to run a sale process, because if they're not an M&A type person and they only do it quite occasionally, then it can slow things down or just make things a little bit tougher. We certainly encourage people to talk to their accountants and get their house in order. Our business is we don't do business services, we don't do audit, we don't do tax, and we work with people's advisors in that area. But we're lucky that if we need some tax structuring done, for example, we've got They tend to be ex-Big Four people who are now somewhere else. So we get the Big Four smarts at maybe a different price. So, we'll introduce the people as we can, but also happy to do that. And, the reason for talking about that is it's all about preparation. Right. Sale agreements, you've seen a million of them. They can be fairly similar, but, if you want to get a transaction done and do it in a timely manner and keep it pushing along, then the preparation is really important.
The current market, like your type of transaction, let's say in the last 12 months, has that changed? You talk about the sell side where you're acting for the seller, but now you also act for the buyer.
Yep.
Let's just talk about the current type of transactions in the market that you're seeing at the moment.
Yeah, look, we're seeing a range of things. I think when we sit and talk to boards at the moment, they're working out internally how they execute their strategy, and certainly given the current constraints in the market, acquisition's a good way to execute your strategy and achieve the growth you want. It would be fair to say that 90% of the conversations we've had in the last 2 years, the biggest concern out of everyone is people. Like, there's lots of talk in the papers about interest rates, but I can't actually think of a business I've spoken to in the last 6 months that has said to me, no, we're good for people, because they're just not. And they're from manufacturing to professional services. It's across the board. We've got an example in Brisbane at the moment where one of the guys we're talking to, he's got guys labouring on one of his sites, and the guys are getting $85 an hour as labourers, and what does that mean? Well, it means his mates that are doing domestic building, they've got no crew, because why would the guys work then when they can do sort of 4 half days in the city and, be making great money? So I think from the boards we're talking to at the moment that want to execute their strategy, acquisitions are becoming attractive. I think part of that is I think pricing has come back a little bit since late last year. Everyone acknowledges that 2021 tech valuations were just crazy. There was a VC conference this week, and I think it was, everyone agreed on that point. I think valuations have certainly come back, probably to a more reasonable level of, a 2017, 2018 level. So that's getting boards a bit more comfortable that they can go out and do something. The challenge, however, there is often these acquisitions require debt and equity, and it's sourcing that debt. We've helped a professional services firm closed yesterday, buy out one of their partners, rather than they've banked with the same Big Four bank for many years. But the bank said to them, it's going to be a number of months to get through this process. They wanted to buy out their partner in the next couple of weeks. So they've actually gone and taken some private non-bank money, which was surprising to me. But, when we looked at it logically, why would you not do that? They were happy to meet the cost of doing that just to progress their strategy internally and where they wanted to get to. So I think, pricing's definitely come back. We've got a few clients that only like to buy things on the downturn, and they've certainly been in touch. We've got one group in particular that bought part of Ansett, and also bought a business off McGrath-Nicol many years ago, and they've sat quietly probably for the last 3 years, but now they feel like there's probably a bit more value coming into the market. I think there's still uncertainty around interest rates. Obviously the Bank of England put rates up this week, but as Michael Naffler used to say to me, this too will pass, right? So, I think the boards are starting to say, okay, well, we've got a rough feel for where rates will go, but we're going to be, if we're going to do something, we need to be thinking about the next 3 years, not just the next 6 months. But appetite's probably up a bit.
So looking at, say, distressed businesses, so you're acting for someone that wants to buy into a distressed business. Let's say it's McGrath-Nicol or a Quarter or a Cathro and Partners appointed as administrator. They're on the other side.
Yep.
What do there's urgency. Like we spoke at the beginning of the podcast about, the best deals in an administration are the ones that are done very quickly, right? So that's the timetable is much more truncated than, say, a standard transaction. So what's run me through the experience that you're exposed to when you're acting for one of those potential buyers of a distressed business.
I think in part it comes down to the experience of your client. So we've got clients that have bought distressed before. They understand there's no warranties, no indemnities, cash on the table, and you keep going. You're on risk, but that also goes to price. So that's what, and they back themselves that they can do that. When you've got a new client who's for the first time hearing about voluntary administration because a division of a business that they'd offered. So we've got one at the moment. We've offered to buy a division of a business pre the appointment of an administrator. Then the administrator was appointed, and now we're going to go through a process, obviously in line with what the administrator wants, and that's fine. I think the bit I like about buying out administration is there's transparency, and you know a deal's going to get done. So I can say to my guys, in 8 weeks' time, we will be somewhere. Whereas we've seen with other transactions, particularly through COVID and then after COVID, you'll be hot and cold. Someone will decide, no, we're going to put this on pause for 2 or 3 months. And then you've spent time, clients have spent money with tax lawyers or accountants doing due diligence reports. And everyone's fairly grumpy because they've spent, in some cases, hundreds of thousands of dollars and made no progress. So I think the upside of dealing with an administrator is, they want to get the deal done. They're motivated to get a deal done. Administrators obviously are personally liable. So I tend to find they're fairly direct.
Love that.
The bit they fail to mention is administrators often don't own their own houses. But anyway, I think
that's because we don't have any. We're not that rich.
So, I think there's certainly that there is going to be some sort of type of transaction. But certainly, when you're dealing with someone who's done a lot of transactions, but all of a sudden you're saying you don't get warranties and indemnities, and they've got to explain that to their board. It might be in a different language. All of a sudden everyone's ears prick up.
I mean, I've had sale processes, and most of them have been successful, and some haven't. But some of the challenges I see is trying to explain to the interested parties, the ones that don't have advisors, that you can't just set your own timetable around when you make a bid. And of course you get to the sort of the EOI closure date or some sort of hard date around offers, and they just think they can just move the date. And it's just like, no, it just doesn't work that way, because you've got personal liability, you've got the clock's ticking, you've got the voluntary administration timetable, and it's a very different approach, I imagine, than the normal transactions that you would do outside of an administration process.
We've had an example of that in the last 48 hours where an MBIO, we told them it was going to be lodged late, and they said, yeah, that's fine. And then the client got up yesterday and the data room was turned off. And I said to him, yeah, it's turned off because they're going forward. They're not waiting. They're getting on. I'm lucky that I've sort of sat on both sides of the fence. I understand what people are trying to do both ways. But it comes back, get some proper advice, get some proper advisors to help you, or someone with experience in that area.
Yeah, and certainly explain that the administrator can do whatever they want. Like they just say, if we want to keep it to a hard date, we keep it to a hard date. The value of the asset is what the value is at that point in time, and the business is insolvent. I think just sticking with that topic, I mean, the other thing that these clients of yours need to consider is, well, the company has gone into insolvency. So what caused that? And am I buying into something? Yes, it might be $1 I pay for, but it's more about what's the cash burn that's going to happen over the next 2 or 3 months. And usually the records are fairly poor. Usually the contracts are fairly poor because they're unprofitable. But what's the sort of dynamic and conversation that happens there when you're talking to the client about the risks that they have to take on?
Again, we've had that discussion with someone this week. The working capital sort of WIP calculation is going to be massive, and they need to get their head around that. We always suggest to people that in normal transactions and in solvent transactions as well, we would often see a new CFO or a financial controller go in. because we think that helps just understand the financial position a little better. Obviously, in a VA type sale, you don't have the opportunity to do that prior to buying the business. So, what we tend to do, it goes to price on, if nothing else. Like if we're concerned and it's, if we think there's a $2 million hole, that $2 million coming off the top, and you've got to be prepared to walk away, right? So, VA sales are like buses, right? There's always going to be another one around the corner, and you're better off doing no deal than a bad deal, because you're not going to get a chance to readdress it, other short of probably putting it back into administration if you've made a massive mistake. So, we encourage people to just spend, there's a lot of pressure on. The administrators are trying to push people to do things, but don't break your normal process. Make sure you spend your time, particularly around the cash, like cash in businesses. People talk EBITDA and EBITDA multiples and all those crazy things, but cash is still king in these things. And, if you don't understand how the cash moves around your business, that's a problem, and particularly if you're buying something.
And then the first month or 2 months after they buy this business out of an administration they must know that it's going to be borderline turmoil, in the sense that you're likely to probably have to change management, because we know that 90% plus of insolvency matters are caused by poor management. So putting the same management into a purchase business out of administration would almost be like just supporting the problem that caused it in the first place. So, trying to have the people ready to go and ready to get in there, or certainly a framework where they can manage these people, that's a lot to do in such a short space, and to get across the business and to be the winning buyer. So it's very exciting doing these kind of transactions, both as the administrator on the other and then on the other side, because you're forced to really push yourself to do something quickly in order to make sure that a transaction can be done.
The other challenge we can often have is, what does the customer think? So when you're thinking about all your stakeholders in a deal, if you've got a customer that makes up 50% of your revenue, and you've got the opportunity to have 2 face-to-face meetings, and then you've got to back yourself. So, but what do? They put it to price.
I've actually got an example of that. I got approached to act as a liquidator, and the conversation, this was probably 5 years ago, conversation with the accountant was, look, it hasn't gone well. It's a tech company. It's got this platform. They've only got $20,000. They owe $500,000 to the tax office, and there was a couple of million owed by shareholders and whatever. Can you do that for us? Because we had to wind the business down, do an administration, whatever, and so it was an expensive. It was a lot of work to do, and $20,000 obviously wasn't going to be enough. But once we got in, the business shut down immediately. We ran a sale process on this IP tech business, and then we started talking to the customers. And the customers were going, you can't shut this software down. And that's what drove the sale price. And suddenly we went from thinking something was worth $20,000-$30,000, and we sold it for well over, close to $1 million.
Yep.
And great return for the creditors. It actually, what was interesting was that because there was a lot of related creditors there that were quite upset about the money that they had lost, it actually quelled that tension. And in fact, the whole argument between the parties sort of went away a bit, because they got something back and they felt like they got some sort of reward. They'd sort of had their expectations managed down to getting nothing to coming back to getting, it was 30-40 cents in a dollar, whatever the number was, I can't remember. But I think one of the lessons I learned from that is that we have got that customer base question, that issue you raise about understanding the customer base of what you're buying. That can often drive and give you an idea as to what you're actually getting into. And so, I mean, taking it now, we've got a pretty active and interesting market when it comes to transactions. And I sort of define transaction as transactions coming out of insolvency. There's a reset going on a lot of businesses. There's a catch up coming on in insolvency because of the what we call the period of COVID, where insolvencies were down by numbers that if any other industry had that percentage drop, that there would be they'd be discussed in Parliament, right? So 70% down. Court liquidations were 90% down. So that sort of natural number of insolvencies that happened during COVID, that should have happened during COVID, didn't. It's been caught up now, and we're seeing a very active insolvency market. Now, where you sort of like the interest rate rises has got me interested, and I've had other guests on the podcast talking about what they think the interest rate rises are, and pretty much everyone got it wrong. Do you think what do you think the market for the next sort of 12, 24 months is going to look like, say, in your space?
I actually think, given the space we play in, that sort of bit big or SME and a bit bigger corporates, I think it's going to be okay. I think people will need to solve this people problem. And part of that is maybe an acquisition. Businesses should fall over. You guys should be busier, is my view. And to tell people that they can't wind things up during COVID, I understand why they did it, but I don't think anyone really thought the 2 or 3 years ahead, right? So and all of a sudden there is still cash around. I think people are taking time to decide the deals they want to do outside of insolvency deals. Insolvency deals are obviously quite unique. And I think, people are looking at more at mergers. So a couple we've seen where, IT business A and IT business B are going to merge and then call a successful exit. We still have some doubts around that. I think the tech space is interesting, that growth, just for the sake of it, is going to come back to a sensible world where what's the path to profitability, and because businesses need to be profitable at some stage, right? Obviously, tech's quite different with the SaaS type setup, but we think sensible, normal businesses will continue to get funded. There's obviously lots of gloom and doom in the press, but the press never tends to write about good stuff anyway, right? So I think, my view is, I think the insolvency practitioners like yourself are going to be busier. I think that's a good thing. I think there are some businesses that should naturally just be closed and moved on. But I also think other businesses will just continue to tick along and grow. In terms of Australia, we've got lots of agri, we've got lots of minerals. We're surrounded by water, which helps us keep our pricing up a bit. So I think Australia will continue to be an attractive place. If you look around the world at the moment, if you wanted to pack up your family and move somewhere, the Australian dollar is very weak against the US. So if you're leaving the US to come to Australia, housing is actually much cheaper in Sydney than it was 18 months ago, which I know it sounds bizarre given the prices in Sydney. But so I think Australia is always going to be an attractive place. I'm quietly optimistic about it. I think the interest rates will continue to climb, but I probably have more concern about how much have they got to climb to actually make a difference, because there still is a lot of cash around that came out of COVID, and the people have been sitting on cash. Probably the one thing we've seen a little bit, and we don't do a lot in the space, we've seen a few of the PE firms having to hand cash back because they didn't spend it in time. I know one firm in Australia's had to hand sort of the best part of $100 million back. So, wow. I think we'll start to see some of that flow on. But, I think as you and I have discussed a lot over a coffee, this too will pass. We've all...
It's a cycle.
Some of us, I wasn't quite old enough for 87, but Black Friday 87, 2000, 2008, 2015, it's a cycle, as you say, and that's right. What you want. So in terms of what we're seeing, I think our clients will continue to buy stuff. I think their challenge is going to be, how do you fund it? So the founder's got to be prepared to put their hands in their pocket and write their own checks. I think the days of spending someone else's money and not having to put any money on the table yourself is a challenge. And I think the other thing that might be a bit interesting is what's going to happen with AI. I think that in itself might free up a bit of labour in certain sectors, right? But
ChatGPT, it's just it's sort of the top of the list of topics at the moment, and what impact it's going to have on the business. So even in my own business, we talk about it. What does it mean? What do we need to look at? It's a lot more prevalent outside of the insolvency industry and in other industries where are we going to see the whole theory of mass unemployment coming off it? It's going to be interesting. It's going to be interesting to see where that takes us. The technology that's coming out now is getting as close as what they've been alluding to for 2 decades around this whole artificial intelligence, and it's now getting closer to reality. But I just wanted to come back a little bit. You talked about you also do a bit of capital raise. So to finish off the podcast, I thought we might just tap into the capital raising that you do and what you're seeing around that space today, and whether there's been a shift in that space.
Yeah, look, I think in terms of capital for us, the vast majority of that is debt, private non-bank debt. And we've certainly got a group of contacts that we can either send people directly to, and they'll write into a transaction, or there's some good guys around like the cap space guys who have got a fund that will write checks into a business, not just to a property developer. So there's those types of people. The cap space guys, for example, ex Macquarie Bank and ex NAB guys who've seen a spot in the market that they can fill. Certainly their loans are more expensive than a normal bank loan, but they move with speed. They do it professionally, and I think that type of one of the things that's generated that is just the technology, right? So I think you can generate the documents. You don't need that massive bank infrastructure to be able to do that SME type lending anymore. So we've certainly got that. We've certainly got people chasing us to say, if you see a good deal and they want to borrow X hundreds of thousands or millions of dollars, we'd be interested if the security's right. I think one of the challenges we have with that sometimes is the high net worths still want everything, but they also want the high return. So what I mean by that is, they want the first mortgage, but they want the 15% interest rate as well. So, that can take some managing. But certainly I think, there's almost decentralization is probably not the right word, but, the sources of capital now, particularly with the ability just to get online and Google and find yourself another lender outside of the banks is massive. And massive. I think, my only thing with that is just to, no matter what you're doing, make sure it's properly documented, because people are very happy to do it at the moment, but we're probably only 12, 24 months into that. And there's not a lot at the moment where things have gone poorly and a lender's had to go to a Cathro and Partners and say, I need your help to fix this up because it's been a disaster. The reality is, for all that stuff, your loans is only as good as your documentation. So, we encourage everyone that's playing in that space to make sure they get their legals done properly. The money you spend on the legals is the best money you will spend. And we think it will grow. We've started to see groups in the UK and Asia that we're probably going through third parties now, happily lending straight into Australia. The check size has probably come down a little bit as well. So, I think we're part of a global economy, and the tech has certainly helped push some of those things along. So on the equity side, we really don't do too much on the equity side. We certainly talk to a lot of people, and we invest in a few things ourselves personally. And, good deals are still getting done. We saw a deal before Christmas, which is obviously a few months ago now, that the guys had built some interesting tech in the compliance space. People had said to them, you won't get it done, and they got a $3 million check by one lender, or by one provider, one family office, who looked at it and just went, I like the guys and this makes sense, and there's a clear path to profitability. I think, people out there raising on the equity side where they if they're 3 or 4 years off being profitable, it is very difficult unless the story is really compelling. And I think the VCs are sort of jumping back in there. We know Rowan Workman at Scalata, who's, he runs a VC fund in Melbourne. His background is interesting because he actually came out of insolvency. So Rowan's a good guy, and he's been putting on LinkedIn all this week. He wants to write 10 checks over the next 6 weeks, and their checks sort of between $300 and $1 million, plus also the follow-on, which I think when we're talking to people, we encourage them to think, is it cash just for now, or are you going to need them for the next 3 to 5 years? So I think cash is around, but certainly people are taking time. And the debt stuff, I just think that market's going to continue to grow. I can't see it going backwards. So.
Yeah, look, I mean, it's an interesting time. There's a lot of interesting transactions that are happening in your space, in our space, in the economy. But look, thanks, Dave. Thanks for joining The Cut. It's been a great chat. And for those watching, Dave's got his own Moxon Capital. Feel free to reach out to us if you need to get in touch with Dave. But he's certainly one of the experts in this space and has a lot of broad skills around the different kinds of transactions that we're seeing in the market. And it is, as we said, a very active insolvency market at the moment. So you've got the full suite of good transactions, healthy transactions, down to distressed transactions. And Dave's experience covers all those. But thanks again today, Dave.
Thanks, mate. That was great. Appreciate it.
Thank you, everyone else.
Cheers. Thanks, Tom.
Bye-bye.
Thanks for tuning in to Cathro and Partners, The Cut. We hope you've enjoyed today's episode. For more insights, please visit our website, cathropartners.com.au, or find us on LinkedIn.